Hi, Ben Paul and Nick Ung here from Liberty One Investment Management. Hope everyone's having a great day. Let's face it, the markets were a little rough on Monday and Friday recently. We're just calling to let you know what we're doing from a retail perspective at the Trinell Financial Group, and also the conversations we're having with a lot of financial advisors from a Liberty One wholesaling perspective. So the most important thing to always understand in this type of situation, in this type of environment, is the fundamentals are very, very strong right now, both at the corporate level and at the global economic level. We're going to touch on some details here in just a moment. Bull markets die when fundamentals aren't there, when the fundamentals are no longer present. Let me give you an example. Think of the big dot-com bubble crashing. The dot-com bubble crashed because there were zero fundamentals with those dot-com companies, trading at ridiculous multiples, valuations that had nothing behind it. There were no fundamentals. When you look back at the 2008-2009 crash, there's this artificial demand created from weird policies and lending and interest rates and what the Fed was doing. It was an overinflated bubble that really lacked fundamentals. There was very little collateral against loans that were being lent out, etc. So just complete collapse of fundamentals. Now, what I'd like you to do is Nick and I are going to talk to you about some fundamentals, and we're going to share these fundamentals with you because you can have these similar conversations with clients. It's easy to say fundamentals are strong, don't worry about it right now, but some clients need a little bit more than that, let's face it. So I'm going to have Nick talk about some labor market data and some corporate earnings data. I'm going to talk a little bit about global economic growth, and I promise you, by the time we're done with this, you and your clients are going to feel a lot better. Let's pretend Monday, Friday that you were wearing your blinders, you had no idea what was going on in the market, and all you heard was this data, and you tell me if you'd be a buyer or a seller right now.
So one of the economic fundamentals we look at is the labor market. And the reason for that is because the labor market is a good indication of general US consumers' health. And as more people are employed and as they get wage growth, generally the US economy would kind of snowball and kind of pick up accordingly. 70% of the US economy is driven by consumers. And so that's one of the main reasons why the labor market is such an important indicator when we look at overall economic fundamentals. When we take a look at Friday's jobs report, reported labor data as of January 2018, the economy added 200,000 jobs versus 180,000 expected. So unemployment remained unchanged, but the more important thing is that wage growth actually went up 2.9% on an annual basis, meaning on average, the average consumer in the US got a 2.9% increase in wages. I think that's a really important indicator to highlight the strength of the consumers in the US. And it's something that we really look into and see that as a positive indicator for the US economy. Flipping over to corporate earnings right now we're in earnings season, reporting fourth quarter 2017 earnings data. And according to FactSet, so far 50% of corporations have reported earnings. This is 50% in the S&P 500. And of those 50% of companies that have reported already, 75% of those beat their earnings estimates. On top of that, this is the more important information, is that 80% of those companies actually beat their sales estimates. And if this 80% were to remain throughout the entire quarter, as if like every corporation announced their earnings and 80% beat their sales estimates, this would mark the highest number of beats since the data was tracked since 2008. So we're talking about really healthy corporations. It's talking about not only earnings but sales being really healthy, and sales is a good indication of corporate health because that's the top line, that's the main revenue coming into the company before any tax cuts or any R&Ds and expenses that's being taken out. So overall, labor market's strong, corporations are doing good. You see business sentiment, consumer sentiment pointing in the right direction, in the positive direction. Just looking at those two fundamentals and those two indicators, it's both pointing in the right direction.
Beautiful.
Yeah.
So when you look at just GDP growth even, if you take a look at what, let's look at China for example. China just announced 6.8% GDP growth. When you look at the US, second and third quarter last year were both 3% growth. Fourth quarter, 2.6% GDP growth. That's the fastest growth pace we've seen since 2011. Those 3 consecutive quarters. So that is as fundamental as it can get, is pure economic GDP growth, fastest growth pace since 2011. Europe, Q4 was 2.7%. That was 0.1% faster than the US. That's the first time since the global economic recession that Europe grew faster. Now you've heard this buzzword thrown around a little bit, global synchronized growth. What the heck does that mean? How do you explain that to clients? So think about this. When developed worlds, the US and Europe, are growing, most of what we do is we go spend money, and what we spend money on is developed by less developed countries. So the less developed countries have more production because the more developed countries are buying goods and services from those countries. So when Europe, China, US are growing fundamental GDP, labor market growing, corporate profits growing, we're consuming more, that creates more growth in the underdeveloped countries, global synchronized growth. It's a beautiful thing. So pretend you were under a rock the last 2 days and all you heard were these statistics. Wage growth up 2.9% year over year, added 200,000 jobs just announced on Friday. That was 20,000 more than expected. Unemployment rate is unchanged, still only at 4.1%. Of 50% of the companies who've reported so far, 75% have beat earnings and 80% have beat their sales estimates. If that was the only data you had to go after, would you be a buyer or a seller right now? You'd probably be a buyer. Why? Because the fundamentals are strong, and as long as fundamentals are strong, bull markets can continue. Now, I'm laying out those quick facts for clients, and I'm telling them that this is a correction in a bull market, not the start of a bear market. So that's a really key sentence. It's just a correction in a bull market. It's not the start of a bear market. I personally still feel the best is yet to come for our economy and our markets. This is just a bit of a pullback, and some of it gets overemphasized with computers and flash trades, etc. You explain those basic fundamentals and you'll be in good shape with your clients. From a pure Liberty One perspective, as many of you know, Tactical Income Solution and Tactical Growth Solution are a couple of our flagship allocations. To put those specifically into context for you, when you look at what happened the last 2 trading days, Monday and Friday, the Dow Jones was down 7.03%, 7% call it. Tactical Income Solution was down 3.44, only 48% the downside capture, so less than half. Less than half the downside with a fantastic dividend. And if your clients are taking income, did they take a pay cut because the market's down? No, because the dividend is still there, the number of shares is still the same, the share value may be a little less, but the amount they're getting in dividends per share is still there. It's a great buying opportunity, fundamentals are strong, have some positive conversations with your clients, just a couple rough days in the market from a point standpoint, but I'm telling you, the fundamentals are there. We're very optimistic about things. Give us a call, reach out to us via email if you have any questions. We're happy to talk to you or any of your clients if necessary. Have a great rest of the day.